Good day and welcome to the PSG Wealth Local Solutions for the month of June. We'll kickstart our presentation looking to the market update of different asset classes, both locally and offshore. Kindly be aware that these returns are all reported in rand terms. May we dive into the local asset classes. Firstly, what we notice is that locally, aggressive assets were leading the chart for the month, both equities and property, with properties being the one that actually leads all asset classes locally. The conservative asset classes, cash and bonds, respectively, have been lagging for the month, with our bonds being the most to lag, returning a negative 1.18% to investors. When we look at the offshore asset classes, we see a similar display in that the aggressive asset classes were leading the charts and the more conservative ones detracted on their returns. The offshore equity returned 1.17% and the list of asset classes was offshore cash, returning a negative 1.43%. On the next graph, we will show a similar picture but for a longer period, and we have chosen to show a 7-year return. On this graph, as it shows the 7-year return, also reported in rand terms, may we firstly dive into the offshore asset classes. We see a similar picture in that the aggressive asset classes in the offshore space were leading the charts over a 7-year return period, with the more conservative asset classes lagging the two aggressive asset classes. When we dive into the local asset classes, we see that one of the aggressive asset classes, which is the equity, is indeed leading the charts. However, there's an exception with the local property, which were lagging over this time period, all the asset classes in South Africa. This comes without saying because the property sector has been experiencing tremendous pressure over the period. Now, we need to then take these asset classes and these return tables and see how those might have filtered through to our portfolios at PSG Wealth. This table shows the ranking of our PSG Wealth solutions. These portfolios have also been in the market for a long period of time. And what we then see from these is the returns over different periods of time being ranked on a quarterly ranking. And one of the things that comes to my mind when I think about the two tables that we spoke about, as well as this table, is that the market has different variables, and all these variables randomly interacting together, eventually they affect the share price, which then as a consequence eventually affects the entire portfolio. Amongst all these variables that exist in the market, one variable that no investor is immune to is time. And what we see is exactly the variable of time in this table with respect to our solutions. And if we focus on periods greater than 5 years, all our solutions have been earning investors returns in the first or second quartile. And that shows that this variable of time is important to investors as well as portfolio managers when we invest in the market. And we see that we've been experiencing short-term volatility. And though there is short-term volatility, we are dedicated in understanding the causes of these volatilities. We are dedicated to understand what might have been the detractors and what have contributed massively to our returns. And in constantly reviewing this, we keep to the principles that we believe in at PSG Wealth, and really believe that with being invested for longer periods of time in our solutions, we trust that the returns would be able to assist investors to reach their financial goals. And now we'll dive deep into the solutions and find out for the month of June what exactly contributed or what really lagged amongst our underlyings. It is therefore important for listeners to understand that if a fund is lagging, it does not necessarily mean it returned a negative return for the month. It means comparatively to our underlyings, it was the least in terms of returns. This table shows each of our portfolios of solutions, and the next column shows for the month of June which fund within the underlying was leading, and the third column shows which fund among our underlying lagged. We see for the enhanced interest fund, PSG Asset Management, the money market or the SEGI that we have, was leading, with the Net Group Investment Core Income lagging. The PSG Wealth Income Fund of Fund had Prescient Income Provider leading the charts among the underlyings, with the Prudential Enhanced Income lagging. The multi-assets that we have, which is the Preserve as well as the Moderate, shows Net Group Income Core Guarded leading, as well as PSG the Balanced Fund leading the chart amongst their underlyings, and both the 91 Cautious Managed and the 91 Opportunity Fund lagging. When we move to our General Equity Sector Fund, which is the PSG Wealth Creator Fund of Fund, we have the Fairtree Equity Prescient Fund leading the underlyings, and the 91 Equity lagging. These funds have different recommended investment periods or minimum investment periods. The Enhanced Interest has 1 year, Income Fund has 2 years, Preserver as well as the Moderate respectively have 3 and 5 years, and for the Creator Fund of Fund, it has 5 years. And we see over these minimum periods what those funds have been able to earn for investors. And when we look even further into our funds, we have what we run as a quantitative radar screen. And on the quantitative radar screen, this is a fund, when we look at the return of the month of June, going backwards a few quarters, has been lagging the sector average. And what we then see is that only Old Mutual Investors is on the quantitative radar. And do rest assured that funds that are on the quantitative radar as well as the qualitative radar are constantly reviewed by the team. Ladies and gentlemen, thank you so much for your time, and I hope this was in a way informative and have guided your thinking about our solutions.